Hi, my name is George Stagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. The purpose of this video is to show, from my viewpoint, why so many people missed the turning point, not only of the stock market, but they missed, and that to me is the more important thing, because this is what drove the strength of the stock market, is why did they miss the fact that the economy was strengthening. And I believe, and again, believe me, I've been thinking about this for 30 plus years. And and I believe because there is a major, major misconception of what the Fed can and cannot do. I spent 24/7 on this work because it's my passion. Okay, that's what I love to do. And eventually I decided that whatever the Fed says of things has become less and less important. So I know you don't agree because you have been brainwashed like everybody else about the press only, the television, they only talk about what the Fed does, what the Fed thinks, what they longer for shorter, shorter for longer, they raise up, they raise down, and also that kind of nonsense. But I would like to show you what I think is really happening. Please give me just 2 minutes. Then if you're kind enough to follow the whole presentation, that would be nice. But anyway, give me just 2 minutes, okay? This is how things work, in my humble opinion. There is the Federal Reserve only interacts with the banking system. The Federal Reserve was originally set up to safeguard and make sure that the banking system, which is a very important function in any economy, remains viable, remains healthy. Then the banking system is what interacts with business. Is the banking system that by lending money to business or to regular citizens generates liquidity. It is these loans that they make. That's the liquidity that gets into the system. The other important function is that of the government, that before 2020 was, let's say, minor. I know I make you laugh about that, but after 2020, with all the orgy of stimulus and money that they have programs until the Inflation Reduction Act, they throw money at business one way or the other, either through facilitating investing in special industry that is industrial, it's called industrial policy, or just giving checks to people. So business will interact with this inputs, both money coming from the government, besides the government also gives taxes, regulations, and all that, plus the impact of the banking system on business. You have to give credit to business executives that they bombarded by these two huge, massive government functions. They tend to survive. They try to make sense out of it, try to understand what the markets do, try to get all this input from the banks, from the government, and try to make money. And they make money by impacting consumers and other business, of course. And this is where the business cycle and all the financial markets are really impacted from, is the business that impact the financial markets. How? Well, if business see demand increasing, they have to borrow money from the banks. And by borrowing money, if business is booming, eventually interest rates start rising and commodities start rising because they have to finance the expansion and they also have to buy raw materials, they have to hire people. So there is the economy starts growing, and this is what sends interest rates higher. This is what sends inflation higher. And business will continue to do so until there is pain. The business that are run not as efficiently, they start slowing down, some go bankrupt, and then you have the slowdown. At this point, business borrow less, they produce less, they buy fewer raw materials, commodities decline, they borrow less because now the economy is slowing down and interest rates decline. The markets, bonds, and stocks react accordingly. But when the Fed is raising interest rates, it raises interest rates to the banking system, not to business. The Federal Reserve raises interest rates to the banking system to encourage or discourage the banking system to lend to business. But the interesting thing that is happening in this business cycle, that the banking system already, as I will show you, there are some charts, very important stuff. They're already seeing that there is trouble in the economy. So what they are doing, they are raising lending standards. In other words, it doesn't matter what the Fed does. They already not lending. That's why the money supply is slowing down. That's why liquidity is slowing down, because it's not the Fed that prints money, it's the banks that print money. The only thing that the Fed does is to encourage the banking system to print money or not to print money. When they raise interest rates, what they're trying to do is tell the banking system, keep the money with me, don't invest it in the business. But they already, in this particular business cycle, the banking system had decided what to do because they see risk. So it doesn't matter what the Federal Reserve does. Interest rates are rising because business is strong. Why? Because you have the input from the government, that is, they have consumers have a lot of money, they spend it, and business produces, and I'll show you what really is happening. So that's really what the problem is. It's not the Fed. Is that the fact that in this particular cycle, the government spending has been so huge that whatever these two groups do, it doesn't really matter. Things are running by themselves. And interest rates will rise and commodities will rise until there is a crack. And this is independent from the Federal Reserve. Already the banking system, as I will show you, they're already becoming conservative, raising lending standards, and saving cash. So let's now look at the evidence. What I have done is to make a list of what are the bearish indicators, and then what are the bullish indicators. And then we'll put it together and see, okay, this is what really is happening, and this is what is likely to happen. And forget it about the Fed. The Fed doesn't play at all. The Fed is only trying to match the market interest rates to an interest rate that they call Fed funds rate to charge the banks. So let me go from here. Stay with me. I think it's interesting. Okay, what I've done is, as I said, I put together a few indicators that say, okay, this is what tells me that things are really bearish for the stock market, for everything. Okay, everything is going to fall apart. Then I put another set of indicators. They say, George, just a second. All these indicators are telling you that things are doing well. So be careful. Now then, at the third item, I said, okay, given that we have the bearish case and the bullish case, what is the best investment strategy? And then from that, once we have a strategy, we go in the past, look at the past, and say, well, in this kind of conditions, what is the best investment selection? So let's go from here. This is an indicator that I compute in real time. It's from market data and shows what the business cycle does. When it rises, it means the economy is strengthening. When it declines, the economy is weakening. And it's been 1, 2, 3, 4 business cycles since 2008, 2008. So when it was at the end of 2022, this thing started turning up. And I said, wait a minute, everybody's bearish. The world is going to collapse. I mean, everything was eventually the world was going to end. How come this thing is turning up? What's going on? And this is when I started publishing some videos, by the way, on this subject. And this is why I had this idea of putting the bullish indicators and the bearish indicators. And then I said, okay, let's see why this thing is happening. Because if the markets are telling me that there is a new business cycle going on and there is no recession, the market are telling me that there is no recession. Why? When the Fed is tired, the Fed. Okay, let's look at it at the indicators now. This is the case for the bearish case. I'm going to show you a few indicators that say the market is going to go is bearish, the economy is bad, the world is going to end. Okay, this is what most people followed. So let's look now at the bearish case. The yield curve shows the difference between the 2-year and the 10-year. When the difference is positive, that means that the curve is, they say the curve is steepened. When instead the 2-year goes above the 10-year, the curve is inverted. And when that happens, means that credit risk is pretty high. You will probably see spreads between short-term and long, between high-grade and low-grade bonds increasing, and you will also see banks tightening credit standards quite aggressively. So it's not a coincidence that when the yield curve is flat or steepened, that is when the difference becomes negative, like here and like here, then people say the economy is likely to have a recession. In fact, every time this happens, there is a recession. So that's why in the last 12 months, people always said, well, there is going to be a recession. The recession is going to happen, but it did not happen. Okay, let's go from here now. This shows exactly what I was saying before, that the banks are tightening lending standards. This is a survey of the Federal Reserve, is the blue line, which I have inverted. So this means that when the blue line is way down here, means that banks are tightening lending standards quite aggressively. And in fact, every time is at this level, at this level, at this level, or at this level. And now you see a recession. Why? Because banks are not lending or making it very difficult to borrow. So there is a recession. Now, what I did I added the yield curve, which is the red line. Now, the reason I did it because the yield curve leads a change in the lending standards by the major banks by roughly a year. So you see here the yield curve turned positive, but this banks started easing lending standards roughly a year from there. The same thing happened here. The same thing happened here. So what is the implication? Is that even if the yield curve start now steepening and get positive at this level, right? At this level, the lending standards will not be eased at least for another year. So that means that the credit conditions, tight credit conditions that we are having now, are pretty tight. The banks are really tightening, and it doesn't matter what the Fed does, as I said at the beginning, raising or lowering interest rates. The banks see trouble, so they are playing very defensive, and credit is really high risk because of the inversion of the yield curve. So these are two very bearish indicators that everybody followed, and that's why everybody was so bearish at the end of 2022. I told you before that the printing of the money is done by the banks, not by the Fed. The bank print money when they lend money to either business or to the public. So this is the growth of the money supply. The growth of the money supply right now is down here, is negative. So it is the money supply in real terms, that is after inflation, is contracting. Now, we should not be surprised because the bank's lending standards are pretty high. They're really tightening credit. So it's obvious that they're not lending money, and therefore the money's liquidity is shrinking. And this, again, why is this important? Because every time this has happened, there is always been a recession. And this is why people say, well, with the money supply and liquidity so contracting so sharply, we got to have a recession and business has to go down the tubes. But there is another reason why there has to be a recession, and this is an amazing indicator. The red line shows the temporary survey, employment in temporary services. And look at the growth. When the growth becomes negative, there is a recession. Of course, why? Because business, when before laying off people, they do two things. They cut working hours, and of course, they lay off or fire the temporary services, temporary employment. So that's why when you read this, you reach this point, like now, like now, like now, then of course one has to say there is going to be a recession. Not only that, but when this happens, usually the rise in short-term interest rates, these are market rates, they're not the Fed, it's not that. There's a 2-year Treasury yields, which, by the way, they move ahead of what the Fed does, always has done that. First they move, and then the Fed follows suit. So anyway, what this thing is saying, two things. A, we have a recession. B, because of that, because of the recession and of course less borrowing by business, interest rates will peak, and as business becomes more and more defensive, borrowing less and less and less, short-term interest rates will decline. But we are not there yet because we still have to see the recession. Why? Well, this is what the next indicators are going to tell us. This is as far as I'm concerned, is an amazing relationship because it shows the relationship between the bond yields, 10-year and the 30-year, with the growth of GDP, with the growth of the economy after inflation, and this is the blue line. Now, in order to understand the importance of this chart, let me say that from the 70s and the 80s, debt in this country has been growing exponentially. And as debt grew from 30-40% to 122.8% last year, what happened? That growth in the economy started slowing down. So forget about this growth rate that has been caused by the mess that they have done because of the pandemic. But the growth in GDP is going to go down to roughly anywhere between, it's already around 1%, it's going to go between 0 and 1%, like Europe. Why? Okay, what is debt? That means that someone owns bonds, right? So they own bonds and they lend the money, but they want to have the interest paid to them. So the more debt there is, the more people own these bonds, and they want to get paid the interest. But what this means that you and I have to be taxed more and more and more to pay the interest to the bondholder. So what does it mean? That the bondholder gets wealthier and we get poorer. And since we really are the economy, the bondholder don't spend, they cannot spend that much. We have to spend something. That's why as well income slow declines and declines as shown by the decline in the growth of GDP, we have to spend less and less and less. That's why GDP has been going down. Because again, so there is a transfer of wealth between us and the bondholder. And that's why income inequality is increasing. And I strongly believe that the income inequality is increasing because of this transfer of wealth from us, the people who pay the interest, to the owner, to the holder of the bonds. So why do I say that? I say that because debt has been increasing even more, again, to 122.8% of GDP. There is also an amazing studies by Reinhardt on the Journal of Economic Perspectives, that shows that since 1800, that all the countries with debt above 90, 100% are bound to stagnate. This means, and we have already examples. We have Japan and we have Europe. When they have 0.5%, wow, the economy is booming. So why am I saying all this? Because the growth of the economy, if the growth of the economy continues to decline, as it will have to, we are growing 0.1%. Bond yields have to go down to that level. Otherwise, we cannot function. That's the history of 60 years. That's what that is saying. The yields have been chasing down the growth in GDP, which means the bond yields will have to go much lower than the 4-5% that is now. Keep that in mind. So let's see now what are the bullish. Now, clearly this is a bearish chart because it says the economy is going to slow to 0.1%, maybe 0%. Obviously, earnings are not going to be that grow dramatically. Therefore, the stock market is going to stagnate, and interest rates and bond yields will decline to about 0.1%. Of course, the previous slides are very well known to the bears and why they say the world is going to collapse, right? And that's why everybody has been wrong at the end of 2022 because no one saw that, recognized or believed, more than recognized, no one believed that turning point going up in the business cycle. So let's now look at the bullish case. Now, the bullish case, if you have to appreciate what it means, remember the first chart, there are two things. There is the monetary, the Federal Reserve banking system acting on business, and then there is the government part that acts on business directly through taxation, regulation, but above all, in the last 2 years, 3 years, with a ton of money. So let's see now how the bullish case is developing. So what happened to those $9 trillion that the government spent and is still spending in stimulus, infrastructure programs, Inflation Reduction Act and all that? Well, of course, went into the money of the consumers. The consumers bought the goods for business, and guess what? New orders, of course, going to business is going up. So here it is. This is, by the way, all this data after inflation. So all this trend is not what you see during a recession. This you see when the business cycle starts and business starts improving. This is a very powerful trend caused by, again, people spending money and business placing orders to produce goods that consumers want. And guess what? As inflation, after the big jump of 2021, 22 coming down, real wages after inflation, whoops, they're going up. So not only business is producing more, it gets new orders because people are making more money after inflation. And guess what? This trend here is not what happens during a recession. So this starts when a new business cycle underway, which fits, by the way, if you remember the curve that I showed you at the beginning of the business cycle, stronger, weaker. We had 3 or 4 business cycles since 2020. This is what is happening right now. A new business cycle is underway since the end of 2022. Another positive trend is the fact that, of course, people are making more money after inflation. They are spending under inflation. So this is very positive. People were expecting this to collapse. Instead, no, because of what the government has done. This is important. The Fed is out of the picture whatsoever, today more than before, actually. So business, consumers are making money, consumers are spending, they're placing new orders, and orders for durable goods is going up. So this is the economy expanding. This is no recession. This is the beginning of an expansion. Of course, people say, well, but the consumer is depressed, is not feeling positive. Well, that's always the case at the beginning, at the end of a recession, in the beginning of the expansion, because they always are depressed here and here. But then when the economy starts expanding, start going up. And this is exactly what has been going up in the last 3, 4, 5 months. Consumer sentiment, consumer optimism has been going up. Why? Well, they're making more money, they're spending, and jobs are pretty doing well. There's unemployment rate is very low, so be happy. And where did all that $9+ trillion go from the government to business? Well, guess what? Look at the chart of construction. It's straight up, straight up. If you go around a little town here in Akron, I mean, there is not one ramp, there is not an intersection, there is not anything where they don't build new bridges, they put new overpasses, they make a 3-lane freeway to 4 lanes. I mean, it's an endless construction site. That's where the $9 trillion goes. That's where all the money goes, construction. And construction workers make very good money. And of course, they buy houses and they buy new homes. They buy houses, so the housing sector is firm. And this is what is happening. All that money is going to the consumer, is being spent, and has been a very powerful force that the Fed or whoever does not have any way they're going to win. So let's see what's going on next then. So we should not be surprised that the models of the Atlanta Federal Reserve is saying that GDP is growing at 5-6%. Maybe now is actually 4.9, but forget about the number that is huge and it cannot be like that. And I know and you know that has to go around 1% at some point, maybe even 0. So, but it tells you that whatever is happening right now is a strong economy. That's why commodities are going up and that's why interest rates are going up. Because business needs to buy raw materials and business has to borrow money. That's the important thing that I would like you to come out of this video with. So, okay, let's see next. The model of the New York Fed is a little more realistic, and it says the economy is growing at 2.27%. And that is a little more realistic. But again, what is the message? The message is growing. The economy is expanding. There is no recession. So what do the markets think about what I've been talking about? But that's really the ultimate judge of what's going on. Well, let's look at crude oil. Crude oil's bottomed at the end of last year and it started going up together with the economy. Why? Because business needs more fuel, people are traveling more, so prices are going up. When the economy slows down, as in 2021, prices go down. When the economy expands, prices go up. It's not the Arabs, it's not this, it's not that, it's just the strength of business activity that drives commodities higher or lower. Commodities are the most sensitive mechanism that tell you what's really going on. In commodities, this is a commodity index. Strong economy, weak economy, stronger economy. So the commodity market is telling us, yes, what you see in terms of income, orders, construction, housing, employment is correct. The economy is expanding. Now let's see how all this has an impact on the stock market. But before we talk about the stock market, let's look at two more things. One is short-term interest rates and the other one is inflation. And again, short-term interest rates is like the price of any commodity, is the price of the commodity money. And this is what happens is the economy is strong and it keeps on getting stronger and interest rates decline. The economy is weak and interest rates, they rise. Here the economy is weak and interest rates decline. They can be forced by the Fed to reach some abnormal level, but still the trend is the economy. The economy strengthens, the rate on short-term treasury bills is rising. So the point here is, forget about the Fed, but if the economy keeps on strengthening, the rate on 3 months T-bills is going to go up, and has been going up despite the pause of the Fed in the last month, several weeks, by the way. But what is bad about the strength of the economy is that now inflation bottomed and is going up. I'm not showing home prices, but home prices have been going up a little bit according to the Case-Shiller index since February. And the home prices are a leading indicator of inflation. They always peak before and always bottom before inflation. So the fact that they've been rising, that tells you inflation is not going to go down anytime soon. So that's something to think about it. So in spite of all this, let's see now what the stock market is thinking about it. I showed you this chart before at the beginning of this video, and what it shows is how we compute the business cycle from market data. This is a strengthening economy, weakening economy, and so on. We have 4 cycles. So the importance of this is when the economy is strong, getting stronger, the growth sectors are outperforming the market. When instead the business cycle declines and the economy is weakening, the value of defensive sectors outperform the market and the growth sectors underperform the market. So the question is this then the beginning of a new business cycle? If that is the case, then what we should see is that the growth stocks should outperform. Let's see, I have the data in the next slides. This chart shows the performance of the 11 sectors of the S&P 500 from January until recently. And what it shows is exactly what confirms, not what it shows, confirms that yes, this beginning at the end of last year, around October, November, a new business cycle started. And in fact, all the sectors that are outperforming the market are growth sectors. The sectors that are underperforming the market are defensive sectors, are the ones that really outperform when the economy weakens. So the market itself is saying, yes, the bullish case is true. The economy is strengthening because of the huge amount of money that the government has released into the economy. It doesn't matter what the Fed does and raising interest rates longer for shorter, whatever it is, okay? The amount of money that is in the system overwhelms whatever the banks or the Fed they're trying to do to slow down the economy. The economy is strong because business is strong and because they have the money and consumers are spending. That's the bottom line. So what is the best strategy at this point? It's not that obvious. So what's going on? That's the bottom line. We have the Fed, the banks are creating tougher conditions for business to borrow. But on the other hand, business says, I don't care because income is rising, sales are rising, construction is rising, everything is just fine. So the business cycle tells us that in phase 1 is where business expands, start expanding after a recession that usually is in phase 4. In phase 2, the economy is strengthening enough and eventually overheats with interest rates, commodities, and inflation rising. This is when business slows down because demand slows down because rising inflation reduces real income. So people spend less in real terms and business cuts production, therefore start cutting the purchases of raw materials, they borrow less, therefore interest rates start peaking, and then the things that until things deteriorate, until everything is brought under control, which is usually in phase 4, which is usually what happens in a recession. Okay, now based on the data that we have seen before, where are we? Well, the Fed and the banking systems are here in phase four. The banking system is tightening credit. They see the business as stretched. They don't believe what's going on, so they lend just to the safe borrowers. In the meantime, business is strong. Why? Because commodities are rising and interest rates are rising and inflation, as we saw, bottomed out and start rising again. So this is typical of what happens here. So we are still in a growth phase, but awfully close to a turning point. And this is what the indicators are going to tell us. Yes, growth is strong, but sooner or later, that's how every business cycle ends. The rising commodities and inflation and interest rates will keep on rising until something cracks. And I say, forget about the Fed and the banking system, because banking system already they have decided not to lend. So something is going to happen because of keep on rising interest rates and commodities. So, but as far as the current conditions are, commodities and interest rates are rising and business is expanding. That's the bottom line. What am I going to do next? Well, I follow this curve, the curve that I showed you at the beginning, the business cycles, the way it's computed from market data. And right now you see it's going up quite aggressively. So that tells the business cycle is expanding, commodities and interest rates will continue to rise, and growth stocks will continue to outperform the market. Until when? Until you see this. When this curve rises and then starts declining, then there is a transition from growth stocks outperforming to defensive or value stocks outperforming. But until there is a clear evidence that we have reached a peak like here, 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 or here, the growth stocks will outperform. So as far as current investment ideas, again, these are not recommendations. This is what I do and what I believe. The infrastructure stocks, because of the government spending, are attractive. Energy stocks are strong because the price is going up and the economy is strong. And then if one wants to hedge a portfolio, one can always use staples, bonds to hedge the growth stocks part of the portfolio. I want to remind you that I published the Peter Duck portfolio. If you go to our website, you can enjoy a couple of months of free subscription. No credit card required, nothing. Just put your email and you go with it. I wrote 3 books. One was commissioned by McGraw-Hill Education. Is now translated in many Asian languages. Profiting in bull or bear markets, how business cycles impact the financial markets. I also wrote these 2 books. This one, the red one, this particular one is a study on moving averages. You can follow me on YouTube, of course, and I would really appreciate if you subscribe to our video so that every time I publish one, you will receive it. Thank you for reviewing the video, and I sincerely hope you found the information and my approach interesting. With the basic idea is that, yes, the Fed and the banking system are very important. However, what the government is doing is even more important at this particular point in time. Thank you. Take care. See you soon. So long.